Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, March 26th. Hey, today we actually got a few data to point out on the economic calendar, so let's jump right into it. We'll start off with the housing starts for the month of February. So here you can see in January it went from 1.273 million annualized units. Forecast is calling for a little decrease to 1.201, and it decreased a bit further than they expected, down to 1.162 million annualized units. Now, this also kind of comes in the heels of the home builders index, where we kind of maintained from uh, February to March, even though this is 1 month back, but it is much lower than what we saw back in the fall. We were up, I believe, even as high as 70, where now it's about 62. So it has been waning because the economy, they do see the economy slowing down a little bit, and of course that makes them a little bit more uh, leery about expanding too much and getting out of control in terms of uh, construction. And then on top of that, we're seeing less traffic at a lot of these properties as well. So there's a lot less prospective buyer traffic. Let's kind of move on here to building permits. So again, this is kind of like what we would see the future of housing starts. And here we have in January at 1.317 million annualized units, and it dropped to 1.296 for million annualized units. So what we're seeing is that housing starts are slowing down. Even future housing starts will probably slow down due to less building permits are being permitted here, are being granted here. So again, we're starting to see a little bit of slowdown in the housing here, and this is something we'll keep our eyes on. But this is also in line along with fewer prospective buyers that we have just indicated as what they're seeing out there, and I think that's where things are kind of moving. So we'll have to kind of wait and see if how things shake out here. And kind of along the lines with the housing, we got the Case-Shiller Home Price Index. Back in December, we were at 4.6% year over year, and in January it would drop down to 4.3 annual year over year percent here. So again, this is probably the lowest we've had in a while. In the last 7 years, I believe this was 7 years lowest on the indicator. But again, even though it's showing downward trend, it doesn't mean home prices are coming down necessarily. I mean, if you're overpriced, then of course you can see those prices coming down. But it is becoming a little bit more of a buyer's market. As buyers become a little bit more selective, we got here also home price going up a little bit, but not as readily or fast as it was before. So it's just more of a slower pace now. And then last but not least, we got index the consumer confidence level. We had a 131.4. Forecasts were calling for a little bit higher at 133, and it dropped down to 124.1. This is kind of along the lines of what we've been kind of experiencing the last couple of months. We had the partial government shutdown. We had fluctuations in the market, in the stock market. We've had jobs and stuff, jobs reports. Some that weren't too great. Uh, Even though for the most part unemployment rate is low, and even the job openings, we still got quite a bit of job openings out there. But again, it shows that people have faith where the economy is moving. But again, there's some sentiment of the residuals of what we've kind of been going through the last month or two here this year. Let's kind of move on here. But today the stock market is up. We do got some cabinet level meetings between U.S. and China. So basically, Lighthizer and Mnuchin are over in China right now and speaking and trying to see if they can iron out some of the uh, wrinkles in the agreement to come to that agreement, so that way we can have the two presidents meet up and finalize the deal here. There's also Brexit's in the news. They did postpone the dates from the 29th. I think they moved it 2 weeks further down, but there's a lot of control issues in the sense that the Parliament is trying to take away the control from Theresa May's and try to, so there's a lot of animosity, or not animosity, but the uncertainty in that market right now. And of course, the stocks aren't going to like that very much. They're worried that this could be a hard divorce from the EU, and with basically what that means is that England or UK leaves EU without any trade agreement, and they think that could be really disrupt the markets over there. Today we got a few Fed speakers out there, Fed members speaking out there today. So it's yeah, as always, depending on what they say, could move the markets or not. But definitely the investors will be listening to them and make sure that if there's anything that catches their ear, and if there's something that surprises them, it could move the markets one way or the other. So let's kind of move down here a little bit further, see how the bond market is doing. Bond market, again, we're kind of in the same position. We haven't had a lot of movement in the bond market. We were up, I think, about 3 basis points yesterday. Now we're up about 3 basis points today. Um, actually, I don't think we were up 3. I think we were almost unchanged. So mortgage rates today are going to be unchanged from even yesterday, even Friday's, because it really haven't moved a whole lot since Friday's close here. Uh, so that's kind of where we're at with those. And then 10-year yields did come down a little bit. We're down to about 2.43 right now on the 10-year Treasury. All right, so that pretty much wraps things up. Mortgage rates again are unchanged, so not really a whole lot of change there. This Brexit thing is probably one of the big things that could shake the markets, or also if we come to an agreement with China, but that looks like it could be a little bit longer than we expected. But Brexit could be more of what the investors will be watching. So going forward, I would definitely keep any eyes and ears peeled to Brexit, see how the markets react. If the stocks obviously don't like the news, that a lot of that money will go to a flight to safety to mortgage-backed securities, which would help interest rates. Otherwise, again, if the markets are taken off, that money will probably come out of the bond market and go into the stock market, and that rates will probably worsen. So these are some signs to kind of keep your eyes open for as we go forward here. To be a little cautious, we do got some geopolitical news that could be very volatile to the markets here. All right, folks, you guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.